Okay, before we head in this week, just a reminder for applied level subscribers that Monday, which is tomorrow, will be the first week up of financial modeling. It'll be in sector studies. I'll make a separate folder for it so that you can find everything in there. Before we even begin to work with a spreadsheet, we first have to understand the company we're dealing with, which is we're going to start with Costco, then we're going to follow it up with Capreit. So I've put together one video for Costco. This is an hour and a half long. It is me just walking through on black screen what we need to know, what we should understand about this business before we even begin to head to the spreadsheet. There'll be another video up about financial modeling itself and some of the things we want to think about before we even get to a spreadsheet. There's a lot of work we do before we do that. If you start financial modeling with just opening up Excel and say, okay, let's go, you're gonna make a lot of mistakes. You're going to end up doing a lot of after work, and you'll probably end up with a model where maintenance is just going to be a lot of work to do because you didn't think things out clearly. The third video up will be Costco's 10K. I'm not going to go through the whole thing. It's only going to be about 15 minutes long. It's going to highlight the sections that are important. We're going to read a few things. The 10K with my highlighting will be available for download as well. And then I'm going to show you where you can get all of the information for Costco. We can get pretty much all of it on Costco's website, and how we can get some of the financials in Excel. I'll show you how to do that on the SEC site, Edgar, and on Costco's site. Although it's really only useful for cutting and pasting, for getting the numbers into the spreadsheet we want. It's not going to give us what we want in the form we want, but it's a great starting place as opposed to one finger on the screen and following number by number. It's an easier way to get numbers into the historical set. I would caution you against already doing any historical, building out the last 5 years of historical data for Costco, because we do have to make decisions about what categories to collapse, what categories to sort of say, well, we have this, for instance, debt. You have a current portion and a long-term portion. We're going to collapse that into one item. And I'll explain why as we go through this, I don't want to call it a course, but as we go through this module. Be prepared for it to be about 12 to 16 weeks long by the time we get through the whole thing. Now, this is not a spectator sport, okay? If you really want to develop the skill at going from the written word on the 10K to a financial forecast, you have to do the work. You have to put in the time. So a lot of this stuff, we're going to start from a blank Excel worksheet. I'm not giving you the final model, because if I do, you'll never do it. Yeah, and like I said, it's not a spectator sport. Much like swimming is not a spectator sport. If you hope to learn to swim, you got to jump in the water. You're gonna have to do it. So I really encourage you week to week to follow along and to do it yourself on the screen. So for the historical data, I'm not going to give you Excel spreadsheets with all the historical data. I want you to do it yourself. There is no substitute. It is the only way. So if you really want to know how to do this, you must do it yourself. So we're going to take a number of weeks to get it done. Probably this will end up being some 40, 50, 60 hours long. But that's what it takes when you're learning something. It takes that long. Okay, let's head in. Sorry, one more thing. I've had a number of emails. Where are new positions? Where are new positions? Let me show you where they are. For the applied level, you have applied options, sector studies, portfolio construction and management. Just click on portfolio construction and management. Scroll down to the bottom, and there you are here, positions, new positions. You see 3 videos up here. If you click on that, you will get, this is the August 30th. September 1st was an addition to the August 30th. There's September 6th. I'll be putting up the positions video every Friday. so that you have the weekend to review them. So if you're wondering where they went, it's in portfolio construction. Scroll all the way to the bottom. There's a folder there called positions, and they will be in order so that every Friday the newest one will always be at the top of this list. So there is September 6th positions. We'll start with our economic data. Going to the top of last week, I thought I would include this for China in here. The manufacturing PMI for August, actual reading 50.4, implying that August is better than July. July upgraded to 49.8. This is important because when we look at stockpiles of certain commodities, iron ore is a good one, for example. Price is down significantly from the start of the year. Huge stockpiles of iron ore. Copper, if we look at the inventory level at the Shanghai Exchange, record levels or near record levels of copper. These are two big industrial inputs, iron ore and copper. So if we're concerned about things like dry bulk shipping rates and commodity prices, we really do have to pay attention to China. This is a promising sign, 50.4. The consensus was 50. The previous was 49.8. So we did have an increase, or a better than consensus, and an increase from the previous month. So it beat on two of these measures. I'm not too big on the consensus. I'd rather see the trend over the previous month. I should say a word at this point about the calendar that I'm using. If you're used to using Daily FX, they have decided to put that behind not so much a paywall, but a subscription wall. So you have to tell them something about you. You have to give them information about you. And, well, companies being what companies are, you're going to get hit with a lot of email trying to convince you to open an account and deposit some money over time. And their calendar was okay. It wasn't the best. It was okay. The one that I have found, you can look in the link in the description box. There are two actually that are quite good. One is from FX Street. What I like about that is the timing. When the data is released, it's almost in at the same time that the data is released. Daily FX was a lag of 15 seconds, sometimes to 30 seconds, sometimes up to 2 minutes before they updated their calendar. FX Street, I don't know how it does it, but it does it almost instantly. So you get the numbers almost right away. The other one is in trading economics. They have a very comprehensive global calendar that has a lot of extra detail in there. So I'll put those two links in the description box below under economic calendar. You can choose which one you want. The one I'm using right now is from Trading Economics. FX Street is nice to watch when data comes out, but it's not as comprehensive as the calendar I'm using here. I prefer this one for presenting the outcome. Okay, let's move into Tuesday. We had ISM Manufacturing PMI. This is for August. In the middle here is July's construction spending. So let's just ignore that number right now. 47.2. The previous month, which was July, got upgraded to a contraction. Still contraction, I should say, but 46.8. This is 47.2. This is the diffusion indexes are kind of like inflation. If you see inflation at 3%, then 3.5, then 4, then 3.9, then 3.8, then 3.7. What you have is prices still expanding, but at a slower rate. Diffusion indexes are like that. 46.8 is contraction. 47.2 is still contraction, but you have that change in the slope of the line going on. So you can get to a point where the economy or the sector bottoms and just goes sideways. You'd get a reading of 50 at that point. So that we're moving closer to 50 means that the contraction is slowing down. 47.2 versus 46.8, and that was an upgrade. For employment, 46 up from 43, still in contraction but slowing down. Let's jump to new orders. 44.6. That's last month upgrade to 47.4. So you still have a deepening contraction in new orders. This is for August. And ISM prices kind of the opposite way, something we really don't want to see. 54 in expansion, more expensive than the previous month. July was more expensive than the previous month, 52.9. And the 54 more higher than the previous month and higher than consensus. So something you don't want to see there. Let's go to Wednesday. Bank of Canada interest rate decision. Third time in a row. I think everybody was pretty much expecting that. There were some people expecting 50 based on the last employment and GDP reading we had. Sorry, not the last employment. The last GDP reading we had. We hadn't gotten employment yet. That's the third cut in a row. And the expectation is that it will continue on. So we're at 4.25. Thinking 2.5 by the end of 2025. So that is seven more cuts between now and the end of next year, which makes cash really undesirable as interest rates come down. Still 4.25, but I think it's time to look for other things. Banks tend to do well when interest rates are high and coming down because the curve begins to get an upward slope to it, and we'll see when we look at the US 2 to 10 that we do actually have an upward sloping yield curve now. You will find that some banks over time have set themselves up to be more liability sensitive, which means the duration of their liabilities exceeds the duration of the assets, so that with interest rate cuts, the liabilities will increase more than the assets, so that they are on the wrong side of this one. That with interest rate cuts, they would have a sensitivity of negative. For every 25 basis points, we'll lose 100 million, let's say, in net interest income. You have to rely on two things in this kind of regime. We are clearly in a rate cutting cycle. Turning a bank around is like turning an oil tanker around. You got to make a big wide turn. You have to start focusing on your assets. A lot of your liabilities have the duration they have because you have tried to move customers' money into longer term money or into longer term investments, and you just have to let them run off. What happens when interest rates start getting cut is loan originations begin to increase. So even though you have a contraction in net income margin, this is the margin that you're making, you have an increase in net interest income because loan originations begin to increase. And especially on floating rate debt, it starts to take pressure off some consumers as those rates come down, and it starts to lessen the loan loss provisions you may need or the actual loan losses that you incur. And we rely on good management to shift over to being more asset sensitive as opposed to being liability sensitive. So banks are always a good place to be during a rate cutting cycle. The jolts are a bit dated. This is for July. So what we see in jolts should back up what we saw in the jobs report in August. We saw 114,000 or 118,000. So we should see a difference of that. The job opening 7.6 million down from 7.9 million. The expectation of the consensus was 8.1, so that's a nice drop down. The quits rate I shouldn't say a rate, the quits level 3.2 million. If we look a little deeper, go to the report, total hires were 5.5 million, total separations 5.4. The difference there is about 100,000. That matches what we saw in August in the jobs report. When we get this job report, we see 118,000 jobs added. We think, well, only 118,000 people got a job. Total hires were 5.5 million. Total separations 5.4 million, with 3.2 of them being quits. The rest either retirements or involuntary separations. There's a lot going on below the surface in terms of turnover of the labor force. If you've got 5.5 million new hires in a month, multiply that by 12 months, you get to about 63 million, about a third of the labor force. So there's a lot of turnover under the surface, which is why when we look at average hourly earnings, I do not find that a very good proxy for wage inflation because of the sheer amount of turnover you have going on under the surface. Factory orders, this is for July, backwards looking, 5%. Ex-transportation, 0.4. This backs up what we saw in retail sales, that we had very good retail sales number, headline, but when you look at it, ex-transportation, it really came down quite a bit. We're seeing the same thing here coming down, but 0.4%, up 0.4. The previous was up 0.1, so as backwards looking as that is, that was pretty good back in July. We're in September now. Moving into Thursday, this caught my eye, the Challenger job cuts. This is for August. 76,000. That is almost 3 times the previous month, and it is the highest since March. I don't know if that is a one-off anomaly for the month of August or if this is the beginning of something, but it is worth keeping an eye on Challenger. Usually your seasonality is Q1, where you have the highest level of layoffs, and then they drop throughout the year. The reason is you don't actually lay people off at the Christmas in the Christmas season. You'll announce layoffs in Q4, but you conduct them in Q1 because you do have to give, whenever you're conducting mass layoffs, you do have to give a certain number of days notice before you actually start the layoffs. So you have that quarterly, that Q1 effect for layoffs, and then it drifts down. You have an August that is matching March. Let's go into Canada, and let's contrast something with the U.S. We've got on Thursday labor productivity quarter over quarter for Q2, and same with the U.S. non-farm productivity quarter over quarter for Q2. Canada negative 0.2, U.S. 2.5. This has been an ongoing problem in Canada for decades, is the low level of productivity. That makes, job for job, it makes Canada a high cost producer because of this, because it affects your unit labor costs. Let's just look at the U.S. Look at the previous quarter. Labor productivity was 0.4, unit labor costs were 3.8. Here we have an increase in productivity up to 2.5%. Look what happens to unit labor costs. They drop. So if you have the cost of production rising at 2%, but productivity is 3%, your costs per unit are actually negative. You actually have deflation within your organization in your cost of production, so your margins are increasing. You are more profitable. So for dollar for dollar in the same industry, U.S. firms tend to be more profitable than Canadian firms. So if you were in a particular industry, you'd probably be looking at the U.S. as a base of operations as opposed to Canada, which exacerbates the labor productivity problem. You need some kind of intervention to solve that. And the Canadian government felt that a way to get that done is to actually increase the tax rate on capital, which isn't very bright. That's only going to make this worse over time. But the U.S. has always been a high productivity country. Initial jobless claims 227, down from the previous month of 232. Even continuing jobless claims down 22,000 from the previous month. Don't know whether it's 22,000 that fell off the end of unemployment because their benefits ran out, or 22 that left because they got a job. Going to 10 o'clock here, ISM services. This is for August, 51.5. Previous month, 51.4, and that was an upgrade to 51.4. So continued expansion in services. Employment 50.2, call that flat month over month. This was upgraded to 51.1, but we can see that at 50.2, it's still expansion, but it's slowing expansion. New orders, this is good, 53. This was 52.4, so not only expansion, but expanding expansion, if you want to use that term. Prices paid, this is not so good, 57.3 versus the previous month of 57 versus a consensus of 56. We saw this in manufacturing PMI and in the services PMI. The prices paid index expanding month over month. Not showing up in CPI, hasn't shown up in CPI or PCE. We do get PPI and CPI this week. See if anything shows up in there. If CPI comes in hotter than expected, like I said that last month as well, if it comes in hotter than expected, and it didn't, but if it does come in hotter than expected, you're going to see a big change in the Fed funds futures curve and probably a big reaction in the market. Crude oil, big question mark on what's going on there. Big drawdown in oil stocks, 6.8 million barrels. The month before was less than a million. The expectation was for only 1.1 million. That is a huge drawdown. Gasoline stocks went the other way, expecting a drawdown. You got a build, a small build, less than a million barrels, but still, that's coming off a big drawdown of 2.2 million barrels. Even though you have stocks dropping in the U.S. globally, they are rising. So the question is, where are oil prices going? There is some belief that we are going straight down on oil prices because the world is oversupplied. What happens when prices start dropping is high cost wells just go offline. So as prices drop, supply drops at the same time. So we can't look at the current level of supply and say, well, that's going to drive prices down, because as prices go down, the current level of supply will not be the then current level of supply. So lower prices will just fix that on its own. Bank of America forecasting out 2025 prices, Brent 75 and WTI 71, which is not so bad. Non-OPEC supply will be up 1.6 million barrels per day in 2025. Demand only up 1.6 million barrels per day, and demand 1.1 million barrels per day, which suggests that we would have a build in global oil stocks going on, and that is what they are predicting for 2025, 730,000 barrels per day surplus. China, they point to as a bit of an issue here. High rate of EV sales and higher use of LNG trucks does lower the demand for oil and gas, and do suggest that we have seen peak gasoline demand in China, that it will only decrease from here. If OPEC Plus fights for market share, then they are suggesting you could see the average price through 2025 of Brent at 60. Now, when we say average price, that doesn't mean that you can't drop all the way down to 30 and then come back up again, so that your average price ends up being 70 or your average price ends up being 60. It doesn't suggest that you'll stay at 70. There could be a big day of reckoning coming for the oil market, like we had seen, quite a few years ago when oil went negative. I don't think you're going to get to that point. That was more of an ETF issue and rolling over contracts. I don't think you'll get to that point. But if you have more data suggesting the job market is slowing down, more data suggesting that more economies are slowing down or maybe even tipping into recession, yeah, you could have oil turn ugly. And some of you might be wondering if I'm still doing anything with Oxy. If you have the applied level, every Friday I put up the positions. You will have seen what my plan with Oxy is there. Okay, let's get into Friday, the really interesting day. 8 a.m. Out of Mexico, auto exports year over year for August, and auto production year over year for August. Look at exports, up 1.7%. previous reading was negative 2.7. And auto production up 8.3%, previous reading was 2.7. That is good for Mexico. 8:30 hit, and we got a ton of data on both sides of the border in both Canada and the US. Canada unemployment rate went up to 6.6%. This sort of puts into play the rate cut at the next Bank of Canada meeting. I'm expecting that you will see another 25 basis points. My thinking at the beginning of the year was 100 basis points from the Bank of Canada in 2024. One more rate cut gets us there, and I think with an increasing unemployment rate, we're sort of heading that way. Employment change up 22. You would think, but listen, you got 22. One, maybe your unemployment rate increased because your participation rate increased because we do have a fairly high level of immigration. Maybe that's the case. But when you look under the surface of the 22.1, full-time, negative 43, part-time, plus 65, that is the wrong mix. That is a cost savings method to only bring on part-time people as opposed to hiring full-time. But you have a separation of 43,000 full-time, addition to 65,000 part-time. So your average hourly wages should see a drop down because part-time people are less expensive, 5.2 down to 4.9. Going into the U.S., the U.S. added 142,000 jobs. The previous month, look at that. We thought 118 down to 89. I don't know if anyone's really paying attention to that, but down to 89. 142,000 jobs. I will talk about Waller in a second because a lot was made of it that day that he was open to bigger rate cuts. That's not what he said. That's not. He spoke words like that, but there were sentences before and sentences after he said those words, and the media seemed to just want to ignore all of those sentences and just focus on those words. It would be like me saying the best movie I ever saw, and just taking that, but for ignoring the sentence before, saying if it wasn't for all the bad acting, the bad directing, the bad writing, this could have been the best movie I ever saw. Right? I mean, you got to put things in context, and this was taken way out of context. So I'll give you some context here. 142, unemployment rate 4.2, ticks down from 4.3. This is having to do with the rate at which the labor force grows. If the labor force grows a lot, even if you have a good jobs report, you could have unemployment going up. But if the labor force doesn't grow a lot, even though you don't add a lot of jobs, you could have the unemployment rate going down. So that's a function of labor force growth. This is really positive, by the way. Average hourly earnings month over month, 0.4. It actually came in at 0.399. So here's a good example of where the next decimal place wouldn't have mattered. 0.4. Come down here to average weekly hours, 34.3. Up from 34.2, and that was even an upgrade up to 34.2. 34.3, when you combine more money per hour on average across the workforce, along with more hours per week on average, look what you get for average weekly earnings, up 0.693%. That's 8.6% annualized. That's very supportive for Q3 consumption and for GDP. C has been the big winner. This does not threaten the C component for Q3. And just because people are making more money doesn't mean they're going to spend it, you say. That's not true. In the U.S., the marginal propensity to consume is probably one of the highest in the world. The 70 to 80% of people who receive a paycheck spend every penny they make. They spend every penny they make. So they tend to live paycheck to paycheck. They don't have wealth not because they don't have income. It's because they don't know how to keep their income. They spend every penny they make. So the more money you give them, the more consumption there will be because that propensity to consume is really high. So that is actually good news because this is everybody. Yeah, you added another 142 on top of all the jobs that exist. You added another 142, so another 142,000 people taking paychecks home. And of everybody out there, they got more money per hour and worked more hours per week. That is really big for consumption. Participation rate stayed flat, 62.7. Government payrolls, manufacturing payrolls, that's a sort of a poor trade-off. It would be nice to have seen it, negative and the plus, seen it the other way around, because you don't want government carrying everything, do you? The U6 unemployment rate, 7.9. The spread between the unemployment rate and U6 last month was 3.5. The spread now is 3.7. It is important because we do hear stories about the consumer saying we just can't make it anymore. We just can't make it anymore. The wider that spread gets, the more you have basically two economies, where you do have a group of people who are already in recession, if not depression. Household survey said there was 168 versus 142 for the establishment survey. Unemployment rates in certain categories. IT, 6%, the highest category for unemployment is information technology at 6%. 5.5% is the next highest. That's leisure and hospitality. 6% unemployment rate in IT. I can remember a couple of years ago where you couldn't find anybody in IT. No matter how hard you tried, you couldn't find anybody. Now you got 6% there. For the U.S., full-time lost 438, part-time gained 527, much like Canada. That is the wrong mix. So this is a jobs report that was, 142,000 jobs. That's kind of low. It's the wrong mix of jobs, more part-time than full-time. But it is 142,000 more people bring home a paycheck, and everybody's got slightly bigger paychecks and working slightly longer hours. This does not look like a 50 basis point cut for September. I think we're firmly in the 25, firmly there. However, Waller did say what he said, but let's put that in context. So his talk is on YouTube. So you can look on YouTube. You can find it. He was speaking at Notre Dame. He said the current batch of data no longer requires patience. It requires action. I would be an advocate of front-loading rate cuts, and everybody seems to want to just skip over every time a sentence has an if in there. I would punch my neighbor in the face if I thought it would cure cancer. Well, that's a big if, right? That's a big if. But the media only wants to focus on, oh my God, he threatened his neighbor's safety. Somebody's got to do something. And I said, listen to what I said. If that is appropriate. If that is appropriate. What is appropriate? Significant deterioration, not softening. And when he said that, he said, if I see significant deterioration, he looked up and he put his finger up to the audience, like pointing at them, saying, not softening. He was very specific on that. If I see significant deterioration, then he looks up and says, not softening. So if there's some softening in the labor force, that is not appropriate based on the sentence that he said. And he did go on to say 80 to 100,000 is in line with labor force growth. That if you have, if this number started coming in under 100,000, anywhere between 80,000 and 100,000, he said that's in line. He said we're used to seeing these high numbers because of the post-pandemic hiring, but if you look long-term, 80 to 100 is in line. So a jobs print of 85,000 would not shock him. He would not look at that as significant deterioration and say, okay, well, we're just going back to the long-term number. That is some softening in the labor force, heading back to what the long-term range is. This is not a 50 basis point person. He would be open to front-loading cuts if that is appropriate, and appropriate would mean significant deterioration. That is nowhere near what we have. So that statement, this part here, is what got all the headlines. Front-loading cuts. What do you think about the 50 basis points now? Well, no, that's not what he said. Again, I'll punch my neighbor in the face if it can cure cancer, right? That's a very different sentence. So if you take everything he said in context, that is a very different sentence. especially following it up with something like that, and you got 142, he's not a 50. The Fed will cut. They will cut 25 because he did say it. Hey, listen, the data now does require action. Look for 25. The 50, not going to happen. I don't think you're going to get 50 at any meeting this year unless, as he said as well early in his speech, unless you have some kind of exogenous event that is not part of the economy, but something outside the economy that really hurts at some exogenous event. No, you're going to get a 25 basis point cut in September. And I'm sure in the press conference, Powell will say, we are anticipating more cuts, but we are going to remain data dependent. Rates and yields. Look at all that red ink right across the bar there. The 1 year dropping 28 basis points week over week. The 2 year pulling out another rate cut. The 3 year, there's another rate cut in there. This is the big news here. The 2 to the 10, the capital market curve is no longer inverted. I stopped the counter last week, 788 days of inversion. The 3 month of the 10 year still inverted, 141 basis points, 678 days. So I guess the question is, can it beat this? You got another 110 days. I don't see the federal funds rate, or let's just say the 3 month at 5.13. I don't see the federal funds rate dropping enough such that the 3 month will drop below the 10 year. Look at that, you got 3.72. I don't see that happening. So the money market, the capital market inversion, I think will beat the 788-day inversion between the 2 and the 10. I think that would make that the longest on record by far. And I think we're already at the longest on record now. So we're just extending that record streak on the 3 month to the 10 year. Curvature is coming down as it should. As the curve steepens, curvature does decrease, negative 25 basis points. Now, basically what that is saying is that if you take the 2 year and you take the 10 year and you draw a line, that the belly of the curve will be below that straight line. And that is what we have. Positive curvature means that the belly of the curve would be above that straight line. Negative 25 on that one. Overdone. This is overdone. We'll see on the next screen the pace of cuts being priced into the Fed funds futures curve. And I think it was the combination of seeing 142 on the jobs and Waller taking that one line out of context where he says, I would be in favor of front-end loading cuts without taking everything into context, and the market ran with that. Oh, we're going to front-end cuts. It's going to be 50 basis points followed by 50. Off to the races we went. Overdone. Unless you get some exogenous shock, this is massively overdone. I think the market has gotten way too ahead of itself. You got TLT over $100 on this one. SOMA down another 10 billion, 6.57 in securities, pushes the balance sheet to 7.11 trillion from 7.12, down 6.7 billion. Which is more than the securities runoff. So another 680 million outside of the securities came off the balance sheet. Still curious, money market funds increased 37.26. You would think that some of this money would leave money market funds and head into duration. But perhaps a lot of money is heading into money market funds to take advantage of these last levels of high rates that you're going to get. For retail, up 18.5 billion. Institution pretty much matching them, 18.8 billion. Both up on government securities, but sort of opposite on prime. FOMC now 10 days away. We are in the quiet period, so we shouldn't hear anything from any Fed official until then, but we are 10 days away. Probability at 70% for 25 basis points. I'm going to go ahead and say it's 100%. So the weighting over here has to disappear. China trade balance, and we get that in 1 day, 11 p.m. I'm trying to include some of this here because I think we're probably concerned about commodity prices. A lower US dollar will boost commodity prices, but nothing boosts commodity prices like demand. So if China has any resurgence, or if its market is bottoming out finally, and even if it just goes sideways, knowing things aren't going to get worse is a good thing. So let's have a look at its trade balance. 11 p.m. Tomorrow night. Tiff Macklem in Canada speaking 8:25 a.m. in 2 days. That's going to be important, coming off the back of the third rate cut, with the belief that the next meeting is going to be another rate cut. Let's listen to this guy. And some political porn, if you're interested. Trump-Harris debate in 2 days, 9 p.m. I don't see this as moving markets at all. It's more of a circus. I'm not inherently interested in it, but I'm going to watch it anyways because I can't really look away. It's not serious stuff. That's why I called it political porn. And, who doesn't like porn? U.S. CPI in 3 days for August. U.S. PPI in 4 days. These are going to be big numbers to look at. ECB rate decision in 4 days, and the WASD report in 4 days. Wednesday, you have a 10-year auction. Thursday, you have a 30-year auction. I don't know that this is going to move too much. Here's your big events right here with this one here. That's a terrible drawing there. There we go. With this one here being the thing that's happening this week. Nothing in earnings really. The Fed's not till next week. Your next big data point is in 3 days. Heading out to December, look at the aggressiveness going on here. Last week, more than 3 rate cuts to December, to the end of the year. More than 3 to the end of the year, 70%. It's getting to be almost a sure thing here. 91% that you're going to have more than 3 cuts. 3 cuts. There isn't even 2 cuts being priced in. 2 cuts, no, that's never going to happen. So it's 100% probability that you're going to get 3 cuts. 9.2% that it'll only be 3 cuts, down from 30%. I think the weighting here, I think that is wrong. I think that's wrong. 4.25. Look at that. It's got 42% weight on 4.25, because Waller said I would be in favor of front-end loading rate cuts. And then, okay, turn off the mic. That's all he said. You got to keep listening. New York effective federal funds rate 5.33%. Reverse repo, I told you that it would reverse, and it did. Under 300 billion, 299.271, down 133, 286.66. August 7th was the lowest, and we're sitting at 299. The TGA is going to just jiggle in around 750 billion. That is their target reserves. Up ever so slightly, 3.264 trillion. So at a runoff of 40 billion per month, 26.6 months. Real rates all pull back. Break-even rates all pull back as well. And look at this. The 5-year under 2% at 1.86. The 7-year 1.94. The 10-year pretty much at the 2%. 2.03. Fed funds futures. This is a little too much here. Q3 pricing in 32.5. Q4 84. So 116 basis points into the end of the year. So now we're at about 4.5 cuts for the year. For the next meeting, we get the summary of economic projections. So we're going to get a dot plot. And I can guarantee you this dot plot will not validate the market. Q1, another 68. Q2, another 40. So another 108 basis points in the first 2 quarters. So over the next 1 year, market is pricing in almost 225 basis points of cuts. 9 cuts over the next year. This is not an economy that is an emergency condition. So there must be some bet here on an exogenous event occurring, or a significantly rapidly deterioration in the job market, not just a softening. But based on what I'm seeing right now, I'm not there. I am not there. TLT had a very good week, up 3.18%. SPX down 4.25%. There's an opposite movement there. You've got some implied volatility coming back into TLT. I've made no changes to TLT going into the end of the week. I didn't sell any calls on this, but over $100 here. I just feel this is overdone. If you have the applied level, I did do something on this particular trade. I just didn't use TLT to do it. Mortgage rates Thursday over Thursday unchanged, even with a nice pullback in the 10-year of 14 basis points. The fixed rate mortgage did not budge, so spread increased again by 14 at 262. Our mortgage REITs kind of hanging out, just kind of hanging out there. ABR down 1.47, but it was up on Friday. Thursday night there was a Form 4 posted, insider buying. Friday night there was another Form 4 posted, more insider buying. So you got more insider buying going on while the investigation by the DOJ and the FBI are underway. You have more insider buying going on, right? I mean, I don't know what sends a better signal to the market. I'm going to be really eager to hear their quarterly call, which will be the first week of November. Keep in mind, we do have earnings season coming up in about 4 weeks. It starts in earnest second week of October. We're back in earnings season. We're back in earnings season, just in case you thought that was all done with. IYR and XLU pulled back. This is odd. XLU pulling back with the yield curve. The long end of the yield curve, yields dropping. That you would have XLU pulling back. Perhaps investors in XLU or in that space, reach the same conclusion I reached in the day, is that this is overdone. These rate drops on the long end, this is overdone, and maybe they decided to step out before the rest of the market figured out it was overdone. All the home builders pulled back, but they were certainly up strong on Friday. But over the week, they pulled back, and so you have pullback in the ETFs there. For corporate spreads, are they coming along finally? All of them up except Triple C. It's like, I don't want investment grade. I don't want AA, Triple B, but some of this Triple C, yeah, give me some of that. That seems odd. SIFMA gives us our issuance for the month of August over here. Year to date, 31.3% over the year before. Investment grade for August, 107 billion. Last August, investment grade was only 68 billion, and high yield 19.4 billion. Last August was 10.4 billion. You will have rates coming down, and you have had yields coming off the long end of the curve, with credit spreads remaining fairly tight. So typically when corporations have debt that's due, they usually issue debt to retire debt. The reason they do that is not always because they don't have the cash, is because they want to keep a certain capital structure. So let's say they have 30% debt in their capital structure. That is their optimal capital structure. As debt matures, they will issue new debt to replace the existing debt for no other reason than to keep that capital structure. They will be issuing that new debt on a going forward basis at lower rates than what we've seen over the last year, because that long end of the curve is coming down. For high yield, it's the 3 to 5 to 7 year maturities that matter more, maybe even up to the 10. For investment grade, it's the maturities greater than 10, 15, 20, 25, 30 that matter more. And all those yields are coming down. So as they roll over their debt, they may get a better rate. More so for high yield, because high yield tends to have shorter maturities. Okay, S&P 500, the interesting one Forward 4-quarter operating earnings, LSEG, 260.6. That is an increase from what we saw last week. SPGlobal, they didn't have anything last week. This week they have last week's at 257.36. I don't know what's going on there. But let's take the average of that. Look at the closing SPX of 54. We're at 20.88 times forward earnings from 21.85. One full multiple came out. Another full multiple out would put us pretty much at the 200-day moving average. Another 4.7% down would put us under 20 times forward earnings. That's when you can start looking at S&P saying, well, okay, that's getting a little bit better. Can you get down to under 19? If you do, that's really looking interesting. If you can get down to 18, I think you have a good support there. Implied volatility is back as well, so it is becoming more profitable to play the options on SPY. We did form a double top last week. We had this going on. I said, there's our V coming back in. And if you recall last week, I felt that we were at a fundamental top in the market and that I was moving my short position into an actual directional trade as opposed to just allowing me to extend my long positions with more safety. I said that I was actually making it a position now, and that worked out quite well. I said I felt we were at a fundamental top, if not a psychological top, and a psychological top would mean that the market thinks that it should trade more than 22 times forward earnings, maybe 23 and 24. So that you could have still gone up, but we did not. We did form a double top on the market. All-time high 564.40. We are down 4.54% from the all-time high. Another 4.7% brings us to the 200-day moving average at 513.69. That would give us our correction, our 10% pullback. 50-day moving average is above the market right now. It's 1.88% above where the market is. So you do have in a technical perspective, two points of resistance to the upside. You have 548.91, which is the 50-day moving average, and then you have your double top sitting pretty much at 564. You do have support below at 513.69, 4.7% down. I am a betting, you hear people say sometimes, if I were a betting man, I would, but I am a betting man, and I am betting that we probably have more downside to go. I didn't close any of my short positions, but I am going to think about adding some puts in around 500, and as we keep moving down, 490, 480, 470, I might add some puts there. I wouldn't mind the SPY being put to me at those prices, but it's how we get there, how orderly we get there, and what the tone is going into that. We don't have much reporting today, but I am very happy to report that everybody agrees. I didn't look at SPGlobal because they're just not updating anymore. I think maybe our fellow there, Mr. Silverberg, is losing interest. LSEG reports that 3 companies are reporting. SectorSpdr.com reports that 3 companies are reporting, and they all agree on the 3 company names, and they all agree on the dates on which these companies are reporting. We have a 100% accuracy ratio between the 2 of them. That is something. There's only 3, so I guess when it's a low number, they have no problem with that. It's when you start getting like 100 companies reporting that it all just breaks down. So Monday, Oracle. Thursday, you have Kroger and Adobe that are reporting. Now, before we leave here, let's talk about one of the other things going on, which is in the semiconductor space. We're seeing NVIDIA sort of drop down, and on Friday, you saw Broadcom take a big hit. If you go through Broadcom's earnings, it's not that bad, but it is a reliance, a heavy reliance for their earnings on the AI side, and the AI side is slowing down. Still monster revenues, but slowing down. Kind of like Nvidia, still monster revenues, but slowing down. And for Broadcom, they're still relying, I shouldn't say still, they also rely on the hyperscalers. You know, the big customers. Nvidia reports that it's got 5 big customers, A, B, they call them A, B, C, D, and E, with A, B, C, and D representing 46% of sales. Broadcom, same thing. It's relying on a few big customers. At some point, they're going to be done. And if you get a pullback in these big customers, if they're not seeing the return that they need to see, or if they feel that if they slow down a little, much like the auto industries all ran to EV and then they said, oh, hang on a second, let's just slow down. It's, you know, it's not really where we want it to be yet. If these big hyperscalers start seeing the same thing and start pulling back, being that it is 46% of Nvidia and a significant part of Broadcom, I didn't do a deep enough dive and walkthrough of their statements and their business models to determine how big their customers are, but they do mention reliance on significant customers in the AI space. You could see significant corrections to the downside here. Before the AI craze really took off with Nvidia last year, in May, reporting, suggesting we're going to grow significantly because of AI, and that started the AI boom. Broadcom was sitting around $70 to $75 a share. So even though you've had a pullback to $130, if the AI hype comes out, I don't know that you'd get back to 70, 75, but sub 100, right? Same with Nvidia, sitting, I think, just a little over 100. You break that 100, you could probably run to 78, because it did have support a couple of times at around 780. You could run to $78. That would take down the whole semiconductor sector. The SOXX could break 200 on the downside and head down, but I think that would all just be temporary. And when I say temporary, we're talking a couple of quarters maybe before it starts to find a home in a more respectable valuation and begin to grow from there. I would be very careful in that space. I don't know that I would be buying something that you don't want to own for a period of time, because I think in the short term, anything you buy at these prices will give you losses, and I don't know that that those prices would be revisited for some time. I think I would wait, have patience. AVGO under 100. Well, the ticker AVGO, that has to do with a bunch of acquisitions and mergers from way back. But Broadcom under 100, I'd start to look at and say, well, that's interesting. Nvidia, I don't know. If you see them, break 100, there's a very real possibility they can get to 78. So if you're in this space, I would say, stay safe and don't be a hero. I think there's going to be good opportunity, a lot of good buying opportunity in the next couple of quarters. I just don't think it's Monday. And that's it.